I think in the short term, you could see prices going lower. I do, simply because of there is now a rising chance that you will see the Fed actually raise interest rates on the front end of the curve, which really doesn't mean a ton. But I think you could see that happening. But, in the long run, it's not an issue of inflation and interest rates.
The global financial architecture is rapidly approaching a historic tipping point as unsustainable sovereign debt collides with shifting monetary power. Investors relying solely on mainstream headlines are missing the structural breakdown occurring deep within the global bond market. Andy Schectman, CEO of Miles Franklin and a veteran precious metals analyst, contends that while short-term Fed rate hikes could temporarily pressure metals prices, a far more dangerous sovereign debt trap is unfolding. Governments are forced to issue trillions in treasuries while spending more on interest service than national defense. In our view, when interest servicing eclipses national defense, fiat currencies enter an irreversible debasement phase. Schectman predicts that as physical gold and silver drain from Western vaults into new Eastern settlement rails, paper price suppression will collapse, triggering a massive, long-term revaluation of physical commodities. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The bond market is sending a warning, Jared. That's not about interest rates. It's more about tomorrow's debt. So forget about today's interest rates. Think more about tomorrow's debts. We know, Washington knows, and the people who buy the bonds know that we must issue trillions more in treasuries, and the only way to attract buyers is with higher yields, right? And so that means higher borrowing costs. But the issue is that it's not about inflation to me. The issue isn't about inflation, especially when you look at the fact that you could argue we're in the bond market debt trap, where we've survived for a long time by borrowing at artificially low interest rates, right? But as bond yields rise, so does the cost of servicing the debt. And now we're borrowing just to pay the interest on the debt. That's the debt trap. And when you cross what's called the Ferguson line, when you pay more money to debt service or interest on the debt than you do for, as a superpower, than you do for military, those countries cease being superpowers. And so I think when you talk about what it really is, it's more about confidence. And I think that, this isn't inflation. Governments are drowning in debt. And if interest costs are rising, the bond market is beginning to recognize it. And so I think when you realize that, to your point, Fed will never find all of a sudden gospel in trying to normalize its balance sheet or achieve austerity, reacting to inflation. They can't do it. If they do, and rates really go up, if they and they really try to fight inflation, then you have a very big problem. You have a massive issue with a system that has been distorted through suppression of interest rates. And the ramifications of what happens when rates go too high. And so I think, to me, the reason rates have been rising in conjunction with the central banks buying more gold than at any time in history for the first quarter and lying about it by a factor of 15, where they said we bought 16 tons and the World Gold Council says you're all lying by 15 times minimum. The import-export numbers show it's 244 tons. What the bond market is reacting to, in my mind, is a loss of confidence in paper promises. And so would rising interest rates attract people to a sinking ship? I don't know. Would it? Why are we seeing the biggest money in the world shed U.S. treasuries and buy gold? Why are the central banks, who are the most well-informed traders in the world, who print the money, buying the one thing in levels no one has ever seen that they can't print? Why are we seeing record deliveries on COMEX? I don't care that all of it's not leaving the COMEX. That's something that people fixate too much on in my mind. What if it was the U.S. government under the Exchange Stabilization Fund, which Scott Bessent runs, for national security doesn't need congressional approval. So they have all of this gold and silver standing for delivery through proxy entities like the banks and leaving it on COMEX to throw everyone off the scent. Who's going to steal their gold? Who's standing for delivery for 20 billion in gold in February, 14 billion here last month, every month in the billions? Who's doing it? Contracts never stood for delivery. COMEX contracts were designed for farmers planting a field of wheat in April, wanting to guarantee the price in September. Take out all the variables. The baker who needs wheat for his bread, well, he needs, he wants to buy it. He's happy with the price. They meet in the middle. Or a producer of gold who knows how much gold's coming out of the ground will forward sell production to the market to guarantee a price that he's happy with. Or a company like mine who has millions of ounces of silver in the warehouse. If the price falls, you go out of business, but not if you sold short. So one goes up, one goes down. It allows you to be market neutral. It's turned into anything but that. And so any of those entities that I just mentioned, a farmer, not going to stand for delivery for wheat, a producer, not going to stand for delivery of gold, or someone like me, I'm not standing for delivery. I have it. So the point of it is that it was used to offset risk. 99% of these contracts would either cash settle, roll forward to the next month, or exit the market.
Global bond markets are issuing an unmistakable warning signal that transcends standard central bank interest rate policy. Sovereign nations have relied on artificially suppressed borrowing costs for decades, but rising yields have locked the entire system into a compounding debt trap. Meanwhile, central banks are quietly accumulating physical gold at unprecedented levels, severely underreporting their actual purchases to keep public sentiment disengaged. From our perspective, this quiet accumulation is not an accident. It represents a calculated institutional migration away from dollar liabilities toward unprintable physical reserves. By deploying same-day yuan settlement systems across Hong Kong and Asia, these monetary authorities are systematically bypassing Western paper exchanges. It is predicted that as physical delivery demands exhaust remaining vault reserves, leveraged paper short positions will face catastrophic liquidity risks, ushering in genuine price discovery. Now, let's get back to the interview.
China not only is the largest producer of gold, the second largest of silver, they accumulate more than anyone. They're buying it nonstop. They've built the exchanges, the rails, the settlement systems now overnight or same-day settlement in yuan. So you have Singapore and UAE that are same-day settlement in dollars. Now you have same-day settlement in yuan, a whole different currency. In Hong Kong, where there happens to be a Brinks contract, a COMEX contract that is delivered to Brinks Hong Kong. That's COMEX. So you're stupid enough to short the price here in the West. Well, guess what's going to happen? We'll stand for delivery in Hong Kong. Thank you so much. And you'll begin to see real price settlement over time and less volatility as these exchanges in China have not only pulled all of the retail ability to buy futures contracts. They close that. Unless you are a legitimate hedger, you're done as of the 24th. But they're promoting and incentivizing to the nth degree physical ownership through state-sponsored accumulation programs. They want their people to hold the real thing. And the exchanges and the same-day settlement and the rails that they are building will very quietly and very slowly challenge the Western hegemony in price setting. Now, let's not forget that the Chinese also own the LME, the London Metals Exchange. That's not the LBMA, which is bullion. LME are base metals. And they're building all sorts of warehouses throughout China that house the metal that's traded on the London Metals Exchange. They go around the world striking contracts, buying up all the rare earths they can find and all the base metals they can find. They already control the majority of all the refining in the world and the manufacturing. So they are a formidable foe. And in a world of commodity competition, we're well behind the eight ball. They own more, they produce more, they refine more, they manufacture finished products more. They are ahead of that race. And I think someone got to Trump and told him that. So if you wanted to do this in a manner where information travels like that, and you don't want the world to crowd you out of your trade, you keep an arm's length at it. You have Tether do it on one end, you have the commercial banks do it on another end, and you suppress the crap out of the price to throw everyone off the scent. But if price was really that big of a deal, then why would the biggest money in the world, the central bank, stand for delivery at levels no one has ever seen before, the all-time high levels first quarter? Why did China import more silver than ever before the first quarter?
Yep.
Why did we see 20 billion in gold delivered to COMEX the first quarter, 14 billion last month, billions every month, as the price has been destroyed. Price is a tool of misdirection. The biggest money in the world understands that, and the public doesn't. As the public sold and bailed, the central banks bought more than ever before for the first 3 months of the year, and then lied about it by a factor of 15. So I think, I think these things are, you have to sometimes, none of this stuff's going to be easy. The one thing that I have done consistently for the last 5 years is have the balls to sit up here and say things no one else will. I said this with the BRICS 5 years ago, nonstop. I say things that I believe, and I will tell you they're all rooted in fact until you get to the connect the dots phase. Could it be that they're doing this? Well, I don't know, but why would the central banks be buying this much? Why would China be buying this much? Why would we see these kinds of deliveries on COMEX? And why is it all being lied about? And then outed by the World Gold Council and Goldman Sachs. Now, I'm just simply saying that it just seems like there's more to it than meets the eye. And when you try and find a logical explanation, look, Scott Bessent is a gold bug. It was his largest holding when he ran Soros's hedge fund. If you watched him on Jesse Waters, he could hang in this conversation with us, and he knows it. So wouldn't it be apropos that he would say, look, this is national security. Silver is already a critical mineral for national security. And you know what gold is too, because the West is falling way behind what the rest of the world is doing. We need to do this. We're going to make it critical under the national security guidelines of the Exchange Stabilization Fund. We don't need congressional approval. Start bringing it in, and you all shut your damn mouths, and you'll all walk away happy, whether it be Tether or the banks that are working proxy for the U.S. government. Could it be? Sure seems that way to me. And, when you look at how much metal is being pulled off, we've talked about how 39 million ounces of silver left COMEX in February. Well, that's almost 3 million pounds and $4 billion. And where the hell did it go? Who moved it? But these are the questions that aren't being asked, and people focus on the wrong things. People say, well, the Fed's going to not raise rates or not lower rates, and they're going to have to be hawkish. So we believe, due to forward guidance, that gold's going to sell off. But okay, so gold falls, and then the most sophisticated traders in the world, the central banks who are above the Federal Reserve on many levels, at least in terms, they have the same level of information or more. Oh, that's right. They bought more than ever before as the price was being kneecapped. So the point of it is that price only misdirects the public, the inside information. Yep. And when the price is being misdirected, no one pays attention to it. I got a guy who lives across the street from me. He's one of the biggest money managers in the country. Huge. Morgan Stanley, billions of dollars under management. And the only time he says anything to me about it is when the price falls. He'll yell from across, what's going on with silver, Andy? I want to be like, you son of a bitch. If I had a slingshot, I would shoot it at him. But it's like, that's where it ends. They don't look at the fundamentals because price even misdirects the mainstream analysts who are, it's not holding up in the face of all this inflation and all this craziness and should be higher. Okay, fine, dummy. Then why are the central banks buying it hand over fist? Why? Who's standing for delivery here? Who? These are the things that need to be asked that are counterintuitive, and why price is able to misdirect everyone, and why seeing a new settlement system, an exchange that actually settles in a different currency same day, will lead to real price discovery and will make an entity like a Western commercial bank think real long and hard about going naked short large amounts to drive the price down, when you can just say, I'll stand for delivery in Hong Kong, please. Thank you so much. That's an existential threat. So could it smooth out volatility and usher in real price discovery? I expect it will. Suspect it will. But how does that all play out? Not quite sure. I guess we're about to find out.
Artificial price suppression in precious metals serves as a powerful tool of misdirection, keeping retail investors disengaged while institutional heavyweights aggressively stack physical bullion. Behind closed doors, central banks acquired over 15 times more gold than officially reported during the first quarter, taking physical delivery of billions off Western exchanges. Strategic entities, likely operating through proxy channels under national security guidelines, have quietly stood for massive physical gold and silver deliveries to lock in critical mineral reserves. From an independent analytical standpoint, this growing divergence between paper spot prices and physical delivery volumes marks the final stage of paper market credibility. Eastern powers already control the majority of global refining, manufacturing, and raw material processing, leaving Western economies severely vulnerable. While mainstream wealth managers remain blindfolded by temporary spot price dips, the world's most informed financial actors are shedding paper treasuries for physical assets. It is predicted that this aggressive physical draining of Western vaults will soon reach a breaking point, causing paper derivative manipulation to collapse and triggering an explosive revaluation of gold and silver. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.